All right, Guru Nation. So I wanted to make a quick technical, like back of the napkin math for you biotech investors because the other day I did a video on biotech buyouts. Currently, the if a biotech doesn't have earnings, the multiple is typically 5.7 times peak sales. And once you get 5.7 times peak sales, so for example, let's say in the case of IOVA, the peak sales, which are projected to be 1.5 billion. So you multiply 1.5 billion times 5.7, which is the multiplier, and you get the enterprise value of 8.55 billion. Now, why is that important? Because if you want to try to guess or figure out what would be a fair share price for the buyout, you need to know the enterprise value, which we just discussed. In the case of IOVA, it's 1.5 billion, which is the peak sales projected from Gavi, times 5.7. So that's 8.55 billion. Now, that's the enterprise value, EV. Not to be confused with the equity value, also EV. Confusing? Yeah, I know a lot of you guys are confused. I used to be confused too until I kind of just figured it out and crunched the numbers myself. So equity value is the enterprise value plus the net cash. So for Iovance, it's about 249 million. So you add to the enterprise value of 8.55 billion, you add the cash. In the case of Iovance, it's 249 million. So now the equity value is 8.799 billion. So basically 8.8 billion. Now, what's the implied buyout price per share? This is why all these numbers are important. Equity value divided by the diluted shares. So Iovance has around, at the time of this video, 397 million shares. So the implied buyout price per share would be the equity value, which we couldn't get to without knowing the enterprise value. So the equity value, right, divided by the diluted shares. So it's roughly $22 a share. Now, when you look at the stock price today, it's sitting at 250 something. So that's a lot of upside potential. That's a 9x potential, basically. And that's how you spot if a stock is undervalued or not, in my opinion. Now, there's probably like professionals out there, analysts, maybe they're laughing at me. Let them laugh all they want. They get this shit wrong all the time. This is a simple back of the napkin math anyone can do. Now, this isn't foolproof. Multiples can swing 3x to 10x depending on the drug stage. But this is when you get to the stage where IOVA is, where it has great phase 2 data, it's about to have great phase 3 data, it becomes a real buyout candidate, right? So next time you're eyeballing a biotech play, just run this formula. It could be the edge. Now, I wanted to do a little bit more on enterprise value because and this if you want to learn more, just watch more. If that's all you wanted, you're done. Just like, subscribe, comment, share. Thank you. So, enterprise value, obviously, as you've seen above, is a game changer because you need it to know the equity value. So, enterprise value is the total value of a business. And I don't know why on Robinhood, instead of market cap, they should have market cap and enterprise value because enterprise value is essentially market cap plus the total debt minus cash and cash equivalents. Whereas the market cap is just the share price times the shares outstanding, which is probably the easier way for the algorithms to show. But the enterprise value, you can get it yourself too. The market cap and the enterprise values don't always go up and down at the same rates either. It depends on debt, it depends on cash, cash on hand. But the market cap is the share price times the share outstanding, whereas the enterprise value is the market cap plus debt minus cash and cash equivalents. So it's a little bit harder to calculate. And then you could get into like some preferred shares and things like that. But for most of the time, it's just if you're looking back at the napkin math, that's what you need. So here's the formula for enterprise value. Market cap plus total debt minus cash and cash equivalents. Now, the to calculate the market cap, you just look it up. All right. If you want to manually do it, you just look up the share price and then you multiply it by the shares outstanding. You can get this from the company website, Robinhood, Yahoo, whatever. Step two, you add the total debt. So this is short-term plus long-term debt from the balance sheet. All you got to do is go to the most recent quarterly report, which is the 10Q. Then you subtract the cash and equivalents. So cash on hand plus short-term investments. Again, same balance sheet, the 10Q. And that's your enterprise value. Now, we did the Iovan's example, and I showed you why it's at least 9 times undervalued. It's a 9x from here. So $22 would be a fair target price for a buyout candidate, right? And if the data is a lot better in phase three and the next gen till, and if the revenues go up more, that number is just going to keep going up because it's based on ultimately enterprise value plus cash on hand. So I didn't want to make this video too long. I wanted to make it bite-sized for any investor, retail investor looking to get into this stuff. Here you go. You don't have to learn the hard way like me. You can just watch this 7-minute video. Like, subscribe, comment, share. Talk to you soon. Bye bye.